Welcome to Intelligence Gateway.
Hello. Today we are going to learn 9th module Financial Reporting and Regulatory Compliance in Financial Analyst. Introduction. Good afternoon, everyone. Today, we're going to talk about one of the most essential aspects of running a successful business: financial reporting and regulatory compliance. Now, I know what you might be thinking. Ugh, not another boring presentation about numbers and regulations. But trust me, this is important stuff. Whether you're an investor or a business owner, understanding financial reporting and regulatory compliance can make all the difference in your success. So, let's dive in and explore the world of financial reporting together. Understanding financial reporting standards. Financial reporting standards (FRS) refer to the guidelines and principles that govern the preparation and presentation of financial statements. These standards ensure consistency, comparability, and transparency in financial reporting, enabling stakeholders to make informed decisions. Here's a brief overview of financial reporting standards. Generally accepted accounting principles. GAAP is a set of accounting principles, standards, and procedures followed by companies to prepare financial statements. GAAP is country-specific and varies across jurisdictions in the United States. The Financial Accounting Standards Board (FASB) establishes GAAP, while the International Financial Reporting Standards (IFRS) are widely adopted. In many countries globally, International Financial Reporting Standards (IFRS) is a globally recognized set of accounting standards developed by the International Accounting Standards Board (IASB). IFRS aims to provide a common framework for financial reporting, allowing comparability of financial statements across different countries. Many countries have adopted or converged their local accounting standards with IFRS. Financial statement components. Financial statements prepared in accordance with financial reporting standards typically include the following components: balance sheet. Statement of financial position provides information on a company's assets, liabilities, and shareholders' equity at a specific point in time. Income statement. Statement of comprehensive income presents a company's revenues, expenses, gains, and losses over a specific period, resulting in net income or loss. Statement of cash flows shows the cash inflows and outflows from operating, investing, and financing activities during a specific period. Statement of changes in equity presents the changes in a company's shareholders' equity, including contributions, distributions, net income, and other comprehensive income. Recognition and measurement. Financial reporting standards provide guidance on the recognition, when to record, and measurement, how to measure of assets, liabilities, revenues, and expenses. These standards ensure that financial information is recorded accurately and consistently. Disclosure requirements. Financial reporting standards specify the disclosure requirements for various transactions and events. This includes providing detailed information in the footnotes to the financial statements to enhance transparency and enable users to understand the financial position and performance of the reporting entity. Auditing and assurance. Financial reporting standards often work in conjunction with auditing and assurance standards. Auditors examine a company's financial statements to express an opinion on their fairness and compliance with applicable financial reporting standards. Assurance standards provide guidelines for other types of assurance engagements, such as reviews or agreed-upon procedures. It's important to note that financial reporting standards continue to evolve, and staying updated on the latest standards and amendments is crucial. Companies are responsible for ensuring compliance with the applicable financial reporting standards relevant to their jurisdiction and industry. Consulting with accounting professionals, referring to authoritative accounting literature and monitoring updates from standard setting. Bodies like FASB and IASB can help individuals and organizations understand and apply financial reporting standards effectively. Corporate governance and regulatory compliance. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It encompasses the relationships between a company's management, its board of directors, shareholders, and other stakeholders. Regulatory compliance, on the other hand, involves adhering to laws, regulations, and industry standards relevant to a company's operations. Here's a brief explanation of corporate governance and regulatory compliance. Corporate governance, board of directors. The board of directors is responsible for overseeing the company's operations, setting strategic objectives, and protecting shareholders' interests. They provide guidance to management, ensure proper risk management, and make important decisions on behalf of the company. Transparency and accountability. Corporate governance emphasizes transparency in financial reporting, business practices, and decision-making. Companies are expected to provide accurate and timely information to shareholders and stakeholders. Accountability is crucial, ensuring that management is responsible for their actions and that shareholders have a mechanism to voice their concerns. Shareholder rights. Corporate governance aims to protect and enhance the rights of shareholders. This includes ensuring equitable treatment, the right to vote on important matters, access to information, and the ability to hold management accountable. Ethics and integrity. Good. Corporate governance promotes ethical behavior and integrity within the organization. It includes establishing a code of conduct, promoting ethical decision-making, and fostering a culture of integrity throughout the company. Regulatory compliance. Laws and regulations companies must comply with. Various laws and regulations relevant to their industry and jurisdiction. These can include financial regulations, labor laws, environmental regulations, data protection laws, anti-corruption laws, and more. Compliance ensures that companies operate within the legal framework and meet their obligations. Reporting and disclosure. Companies are required to provide accurate and timely reporting and disclosures to regulatory bodies, shareholders, and other stakeholders. This includes financial statements, disclosures of material information, filings, and other reports as mandated by regulatory authorities. Risk management and internal controls. Regulatory compliance involves implementing robust risk management frameworks and internal controls. Companies should identify, assess, and mitigate risks associated with legal and regulatory noncompliance. Internal controls ensure that processes and procedures are in place to monitor and ensure compliance with applicable regulations. Corporate responsibility. Companies are increasingly expected to demonstrate social responsibility and sustainability. This can involve compliance with environmental standards, responsible supply chain practices, diversity and inclusion initiatives, and philanthropic efforts. Non-compliance with corporate governance and regulatory requirements can lead to legal and reputational risks, financial penalties, and damage to stakeholder trust. Companies must establish effective corporate governance structures, foster a culture of compliance, and regularly monitor and adapt to changes in regulations to ensure both legal compliance and ethical conduct. Seeking legal and professional advice, conducting regular internal audits, and staying updated on regulatory developments are crucial for maintaining compliance. Financial statement footnotes and disclosures. Financial statement footnotes and disclosures are an essential component of a company's financial statements. They provide additional information about the company's financial performance and position that cannot be found in the main financial statements. This information is crucial for investors who want to make informed investment decisions. Financial statement footnotes and disclosures provide additional information. Alongside the main financial statements, they clarify accounting policies, disclose contingencies, significant estimates, related party transactions, financial instruments, and other relevant details. The purpose is to enhance transparency, comply with accounting standards, and provide users with a deeper understanding of the company's financial position and performance. Footnotes and disclosures are important for investors, lenders, and other stakeholders to make informed decisions based on comprehensive financial information. For example, footnotes can provide details about the company's accounting policies, such as depreciation methods or inventory valuation. They can also disclose any contingencies or legal disputes that may impact the company's financial position. Without this information, investors may not have a complete picture of the company's financial health. Analyzing annual reports and SEC filings. Analyzing annual reports and SEC filings is a crucial part of making informed investment decisions. These documents provide valuable information about a company's financial health, performance, and future prospects to begin with. It is important to understand the key sections of these documents, such as the income statement, balance sheet, and cash flow statement. By analyzing these sections, investors can identify trends in revenue growth, profitability, and cash flow, which can help them make informed investment decisions. In addition, it is important to pay attention to footnotes and disclosures in these documents, which can provide additional information about a company's operations, risks, and financial position. For example, a company may disclose significant risks related to its industry or regulatory environment, which could impact its future performance. Finally, it is important to compare a company's financial performance to that of its peers and industry benchmarks. This can help investors identify potential risks and opportunities and make informed investment decisions. By following these tips and strategies, investors can analyze annual reports and SEC filings with confidence and make informed investment decisions.
Thanks for watching. For more information, like, comment, and subscribe our channel.